Welcome back. In the last lecture, I started talking about the properties of American options. Now, before I proceed further, I would like to go back a bit and discuss the issue of cost perspective versus the cash flow perspective when we invoke the concept of no arbitrage. Actually, this issue arose in the context of calculating the bounds of European options, European calls. Now, we showed that the cash flows as on maturity of the options in a particular state of the world where S t is greater than k is 0, and when S t is less than k, it turns out to be positive. That means there is at least one situation or at least it is a finite probability for the cash flows to be positive, and therefore, you can also say that the expected value of the cash flows on maturity would be greater than 0. Now comes the cardinal issue. The cardinal issue is because the cash flows on maturity are positive, therefore, the cost of setting up this portfolio at t equal to 0 must also be positive. That is one way of looking at it. The cost of setting up the portfolio at t equal to 0 must be positive. Now, what is the cost of setting up of the portfolio? If you look at it from the cost perspective, then this buying of the call turns out to be a cost. Investing a certain sum of money turns out to be a cost, whereas you are shorting the stock, this is financing. So, this turns out to be a revenue. So, the net cost that works out to plus C plus k e to the power minus r t minus s naught. Now, this is the cost perspective. If you look at the cost of setting of the portfolio, then the signs get reversed, and this has to be positive because it is generating a finite expected cash flow as positive expected cash flow as on maturity. Now, let us look at the cash flow perspective. If I work out as per the cash flow perspective, what happens? This is a cash outflow. This is a cash outflow. A shorting of the stock gives me cash. I said sell the stock in the market, so I recover money. That is a cash inflow, and I invest the money. That is again a cash outflow. Now, the aggregate cash flow is therefore minus C plus S naught minus k e to the power minus r t. Now, this must be less than 0. Why it should be less than 0? Because it is generating a positive cash flow on maturity. So, because you are having a positive cash flow on maturity, the cash flow at t equal to 0 must be negative. So, this is the cash flow perspective. The net result, whether you use the cost perspective or you use the cash flow perspective, turns out to be the same. So, if the payoff or the expected payoff on maturity is positive, the cash flow at t equal to 0 must be negative, or if you look at it from the cost perspective, the cost of setting of the portfolio must be positive. But the signs will be reversed in both cases, and therefore, we end up with the same equation or inequality. In other words, A and B are both equivalent. But we need to be very careful, we need to be consistent, that is the most important point. Whether we use the cash flow perspective or the cost perspective is not the important thing. The important thing is whichever thing we use, we should use the algebraic manipulations accordingly consistently. For example, if we are using cost perspective, then change the signs of all these quantities. If you are using the cash flow perspective, then the signs will remain as it is, but it will be less than 0. So, that is important. Now, let us move on to American calls. Now, we discussed yesterday that on a non-dividend paying stock, early exercise of an American call is never optimal, and we justified it with a qualitative argument that it is desirable in the event that I want to hold the stock up to maturity of the option, it would be appropriate to defer the exercise of the option up to maturity and then exercise the option and acquire the stock if I decide to exercise to hold the stock up to maturity. Why? Because number one, it defers the payment of the exercise price and thereby I get a saving on account of interest, and number two, it enables me to exercise discretion at a later point in time, at the date of maturity of the option, whether I should exercise the option or not. In the event of a significant fall or a massive fall in the stock price, I may as well decide not to exercise the option and do away with holding of the stock, which discretion I would not possess if I had exercised the option at an earlier date. And if I don't want to exercise to hold the stock until maturity, if I want to sell it earlier, even then we found that it would be more appropriate to sell the option unexpired or without exercise, unexercised, rather than exercising the option, getting the stock and then selling the stock. You should not exercise the option, sell the option as it is in the market, rather than convert it into a stock, pay the excise price, get the stock and then sell the stock. That has similar advantages. There is also a quantitative argument which justifies the same thing. As we have seen, the lower bound of the European call is S naught S at a particular point, whatever time the bound is being calculated. Let us say it is at t equal to tau, at which point we are deciding whether to exercise the option or not. Then S c is greater than or equal to S tau minus k e to the power minus r, the present value of k at that point in time. We also know that the premium of the American call has to be greater than or equal to the premium of the European call, because it gives you an additional flexibility. It gives you the right to exercise the option at any point in time within a given period, whereas European options gives you the right to exercise the option at a particular point. Therefore, the premium or the price of the American option, American call, would be higher or equal. In the worst case scenario, it would be equal to the price of the European call. Therefore, this follows. Now, since the interest rate is greater than 0, this quantity is smaller, the present value is smaller than k, this quantity is less than k e to the power minus r tau is less than k, and therefore, c has to be greater than S tau minus k, because this is smaller and this is larger. So, if this is c is greater than or equal to this, then c has to be greater than this quantity. Now, what is this quantity? This quantity is the price or the net cash flow that you are going to receive when you exercise the option at t equal to tau. Why? Because you are going to pay k rupees or k units of money, acquire 1 unit of the stock and sell the stock in the market for S tau. Therefore, what do we get? What we get is the inferences that if I exercise the option at t equal to tau for any intermediate time between 0 and t, then the cash flow, the net cash flow that I am going to get is S tau minus k, which is definitely less than the then prevailing price of the American call. So, it would be better that you sell the American call without exercise at a price capital C, rather than exercise the call, pay a price k, receive the asset and sell it in the market at S tau. So, that is the quantitative argument which again justifies that you should defer the exercise of the American call on a non-dividend paying stock. We will talk about what happens when dividend comes into play later, but for the moment on a non-dividend paying stock, it is always optimal to defer the exercise of the option, American option, up to the date of maturity. An important corollary of this is that because it is never optimal to exercise the American call before maturity, the right or the worth or the price or the value of the right embedded in the option due to the flexibility of early exercise carries no worth in the market, carries no price in the market, and therefore, for the American call on a non-dividend paying stock, we have small c is equal to capital C. Why? I repeat, because the additional benefit, you see, why was capital C greater than small c? Because capital C or the Americanness had the advantage of early exercise, the flexibility due to the early exercise. Now, we are saying that the early exercise is useless. Why it is useless? Because it is not optimal. Therefore, this right will not command a price in the market, and as a result the price of the American call will equal the price of the European call. Now, we come to the other one, the other case. The other case is the case of American puts. What happens in the case of American puts? Does the same logic hold in the case of American puts? Is it never optimal to exercise, to early exercise an American put on a non-dividend paying stock? Let us investigate this question. Let us say this is 0, this is the maturity of the option, and this is any point tau at which we decide, or we are contemplating the exercise of the American put. What does the American put give us? The American put gives us the right to sell the asset, right to sell at price k. The right to sell the asset at a given particular price k. That is what is the benefit of the American put, and it can be exercised at any point during this. Now, the first logic is, if I exercise the option at tau, I get the amount k at tau. If I exercise the option at t, I get the amount k at t. Now, which is better? I am getting the money. Now, this is a case of inflow. In the case of call, we were talking about an outflow. Here, we are talking about an inflow. Now, if I exercise the option early, I get the money early, I can invest it elsewhere early, and I can earn interest on that. If I delay the exercise of the option to a later date, I get the money at a later date, and therefore, I lose on the interest that I would have received on early exercise of this amount k, the exercise price. That is one important factor which immediately comes into play, which is a forthrightly obvious factor. There is another issue. Why would I defer the exercise? Let us investigate this question. I am contemplating exercising at tau. The question is, why would I like to defer it? I would like to you see, what is the payoff of the American put, or any put option for that matter? It is given by k minus s tau. Now, obviously, the payoff will increase as s tau goes down. The lower the value of s tau, the lower the value of the underlying asset in the market, higher is the payoff of the put option, because it is given by k minus s tau. Now, if s tau, in other words, if I would defer the exercise of the option, if I expect s tau to fall further. If during this period, that is tau to capital T, I expect the price of the underlying asset to go down further. If the price will go down further, my payoff will increase, and therefore, I would defer the exercise of the option, of the put option, in anticipation that the price will go down and I will get a higher amount of money. Now, suppose what happens? Now, suppose there is a situation where s tau is already very, very low. It is almost close to 0, or it is at such a level that the probability of its going down any further is very, very small. Either it is close to 0, or the asset is such that the probability of s tau going below this current price is very, very small. Then what would be the logic of deferring the exercise of the put option? There would really be no logic, because you do not expect the price to fall further. That is reflected in the probability. If as per your perception, you feel that the probability of the price going down is very, very low, then there is no logic in deferring the exercise of the put option, because on the one count you are losing interest, and the other count you are not likely, at least as per your perception, you are not likely to benefit significantly by deferring the exercise of the option, because the price is already very low, and therefore, this payoff is likely to be the highest payoff that you could possibly get in this domain in tau to capital T. Therefore, what we have established? We have established that there can be circumstances, there can be situations where early exercise of an American put may be optimal. Now compare this with the call option. Call option, it was never optimal. In this case, there can be circumstances, there may be, there may not be, but there can be. There can be circumstances where the exercise of the put option at a earlier date, at a prior to maturity of the put option could be justified, could be optimal, and therefore, in the case of a put option, we cannot have this. We should have P is greater than equal to P. So, these are important, very important results in relation to American options, but please note, I strongly reiterate that they apply to non-dividend paying assets, assets or stocks that do not pay dividend during the life of the American option. Now, we will talk about put call parity. It really is not a parity, it is some kind of a inequality relationship in context of American options. We have talked about the put call parity of European options. It is quite simple, small c plus k e to the power minus r t, this is nothing but the present value of the exercise price is equal to p plus s naught. This is what we did in the last lecture as so far as European options are concerned. Let us investigate the case of American options. Again we do a similar exercise, again we invoke the no arbitrage condition, or we invoke arbitrage rather, or we try to find bounds such that arbitrage does not occur. Let us work on it. Now, because American options can be exercised at any time between 0 and t, we in addition to exploring the values of these instruments at t equal to 0, that is today, at t equal to capital T, that is the maturity of the option, we also need to have some intermediate point, any arbitrary point, let us call it t equal to tau, to be generic or to be representative of early exercise if possible, or if optimal rather. So, let us look at portfolio A. You have a European call. Now, this is a European call, it is not an American call. We shall relax this assumption at the end, but for the moment it is a European call, and therefore, the premium paid is small c, and because it cannot be early exercised. So, for the moment, now for the moment we are taking its value at 0, we will also relax this at a later point. But at capital T, what happens? If S t is less than k, this has a 0 payoff, and if S t is greater than k, the European call will be exercised and we will have a payoff of S t minus k. So, to repeat, at t equal to 0, we have bought a European call, and we have bought a European call at a price small c. At t equal to tau, we are assuming the worst case scenario, let us put it at 0. It may command a market price if you sell it unexercised, but for the moment we are taking it as 0. We will relax this at a later point, and t equal to capital T, the payoff if S t is less than k is 0, and if S t is greater than k, it is S t minus k. And we invest a certain sum of money which is equal to k, and we get the future value. At t equal to tau, the future value works out to k e to the power r tau, at t equal to capital T, the future value works out to k e to the power r t. The total of this portfolio is given here, minus c plus k is again now the cash outflow. It is not the cost is c plus k. The cost is c plus k, the cash flow is minus c plus k. The total flows at various points in time are given here, k e to the power r tau, k e to the power r t, and here it is S t plus k e to the power r t minus k. So, this is the portfolio A, and let us now look at portfolio B. Portfolio B is you going long in the stock, buying the stock, and if you buy the stock, these are the respective situations. Now, please note, for the moment we are assuming S tau is less than k. The reason will become apparent in the next line. you also buy an American put. If you are buying an American put, you are paying a price capital P. Now, you see, the American put will be exercised if S t is less than k, S tau is less than k. It can be exercised at t equal to tau. It is logical or it is optimal to exercise it only in a situation where S tau is less than k. If S tau is greater than k and you exercise, you don't, there will be no payoff. So, there is no logic in exercising it. If S t is greater than k, you will only exercise it as a rational investor if S t is less than k and S tau, I am sorry, S tau is less than k, and in that situation your payoff will be k minus S tau, because you are long in the American put. And so, if you exercise it, you get k minus S tau, but importantly you exercise it only if S tau is less than k. Now, in these two situations, again if you do not exercise it early, you keep it till maturity, then you get a payoff of k minus S t if S t is less than k, and you get a payoff of 0. If you look at the total payoffs here, now let us explore the total payoffs, that is very important. At t equal to tau, the total payoff of these two works out to k. The total payoff in this situation at maturity works out to k, and the total payoff if S t is greater than k works out to S t. Now, compare the payoffs of portfolio B with portfolio A. T equal to tau, k e to the power r tau, k e to the power r tau and k. So, portfolio A is giving you a better payoff. This factor is greater than 1, the exponential factor. T equal to t, S t less than k, k equal to the k e to the power r t versus k, again portfolio A is better. Now, look at this one, S t, as I mentioned earlier, this is the future value, this is the present value of the same quantity. Therefore, k e to the power r t minus k has to be greater than 0, and therefore, S t plus this expression would be greater than S t. So, in these three situations at least, portfolio A is superior to portfolio B, that is very clear. And please note, in portfolio A, we have assumed that the European call is worth 0 and it cannot be worth less than 0. Now, you will say that we have not considered the case S tau greater than k, S tau less than k we have considered, we have not considered S tau greater than k. Now, if S tau is greater than k, what happens? This the value of the European call, if you sell it in the market provided it is tradable, if the value of the European call will increase if S tau is greater than k, because its intrinsic value will increase. Therefore, the superiority of portfolio A will be magnified, will be escalated, will be enhanced. It will certainly not happen. It will certainly not happen that portfolio becomes superior to portfolio A, because if S tau is greater than k, the American put will lose value, the American put in portfolio B will lose value, the European call in portfolio A will gain value, and therefore, the differential in value of A minus B will be more, A will become more valuable than B. So, in all circumstances what we find is, we find that portfolio A is giving a superior payoff than portfolio B, irrespective of holding the European put up to maturity or exercising it earlier. Even if you exercise it earlier, you get portfolio A is better than B, and even if you exercise this American put, defer the exercise of the American put up to maturity, you still find that portfolio A is superior to portfolio B. What does it translate to? It translates to the cost of setting up of the portfolio A being higher than the cost of setting up of the portfolio B. Cost of setting up of the portfolio A being higher than cost of setting up of the portfolio B. In other words, S naught plus P is the cost of setting up a portfolio B, it is smaller, and C plus K is greater. But as I have argued earlier, this small c is equal to capital C, because early exercise makes no sense. Therefore, we end up with the conclusion S naught minus K is less than capital C minus P. This is equation number 1. S naught minus K is less than C minus P. So, from the previous slide, now we are partly done. From the previous slide, we have S naught minus K is less than C minus P. From this is from the put call parity. Put call parity. For European options, you bring P to this side, you get S naught minus K to the power R T. C is equal to capital C, P is less than equal to P. That means what? That means this P is greater than equal to this. Therefore, the difference gets squeezed, and therefore, we must have that this C minus P. Now, look at this carefully. This small c is equal to capital C. So, there is no problem. As far as the small p is concerned, small p is smaller, capital P is larger. So, when you substitute capital P for small p, this difference becomes smaller, the difference is squeezed, and if this difference is squeezed, then we must have the less than equal to sign with respect to this. In other words, capital C minus P becomes less than equal to S 0 minus K e to the power minus R T. Combining this and this, combining this and this is my 2, sorry, this is my 2, this is my 1, combining 1 and 2, I get this is my 3, which is the put call relationship in relation to American options without dividend paying stocks, or when the underlying is not paying any dividend, underlying does not entail any carrying costs, then this relationship will hold. We have discussed this point. When S tau is greater than K, we have also discussed this. So, this is a very important relationship in respect of American calls and puts. If you can see from here that in the case of European calls and puts, we have an equality here, because there is one point in time at which these things can be exercised and they cannot be exercised at an earlier date. But because here the exercise can be done at different points in time, calls and puts can also be exercised at different points in time. Therefore, you cannot have the equality, you have inequalities. That is important. Now, we come to a very important aspect. Why? You see, I have been emphasizing so far that dividends, the cases that we have considered have been very emphatically mentioned by me as involving underlying assets which do not involve any dividend payments, nor do they involve any carrying costs. In other words, they are plain assets which do not generate any income, which do not generate any expenditure during the life of the options. What happens if dividends are expected? What happens if dividends are expected during the life of the option? Let us say today is t equal to 0 and the option matures at t equal to capital T, and at any point in between, let us say tau, a dividend is expected, let us call it d tau. What is the effect of this dividend on the call price at this point? That is the question that needs to be answered. Now, what happens? Let us try to understand the dynamics. When dividend is paid by the company, the stock price goes down. There is a discontinuous jump in the stock price equal to the amount of dividend that is paid. In other words, the impact of dividend gets accumulated as we move from 0 towards t equal to tau. At t equal to tau, when the dividend is released, or it is called the ex dividend date. In fact, there is a particular date at which the trading becomes up to which the trading is cum dividend, that means the buyer gets the benefit of the dividend, and after which the stock is traded without dividend, and the price therefore is the naked price of the stock without the dividend. Now, this ex dividend date, on this ex dividend date, there is a discontinuous jump in the stock price, a fall in the stock price rather, downward jump in the stock price equal to the amount of dividend. Now, because of this downward fall in the stock price, what happens to the call option? The price of the call option also declines. As you know, what is the call option? It is the right to buy an asset. Now, the right to buy an asset becomes all the more valuable if the market price of the asset is very high. Higher the market price, greater is the value attached to the call option. Now, if the market price goes down due to the dividend payment, the value of the call option also declines. Therefore, dividend payments during the life of the option tend to reduce the call price, and similarly the converse is the case in the case of put option. Because put option involves a right to sell, the dividend payments enhance the value of the put options. There is another approach to it on justifying why dividend payments result in a fall in the call price and a rise in the put price, but I shall postpone that to the point when I start talking about pricing of call options. The pricing of call options make it clear that it is the underlying assets price which has a role to play in the price of the call option. So, in that part we shall defer for the moment, and for the moment let us justify it on the ground of being ex dividend and a consequential fall in price on the ex dividend date due to the payment of dividend, because the dividend gets stripped, or the price gets stripped of the dividend. Dividend is then given to the party whose name appears in the register of members on the particular record date. Now, we will talk about put call parity with dividends briefly, but now first part of it is very straightforward. We have just mentioned that C minus P, if you look at the earlier slide, we mentioned C minus P is less than equal to S naught minus K e to the power minus R T. C minus P is less than equal to S naught minus, this we have already established. Now, as you know, as just explained in fact, if you have a dividend paying asset and it pays a dividend during the life of the option, then C gets reduced, P gets increased. So, this differential gets narrowed, and because this differential gets narrowed, this inequality still holds, right. So, this part is very clear that even in the case of dividend paying stocks, this relationship still holds. I will continue from here after the break. Thank you.